that, I'm going to turn this over to Dr. Matt Dearson. He's going to kick us off today. And Matt, if you want to introduce yourself and you can start sharing your slides, we should be able to go from there.
Good morning. Sound check. Heather, is the sound okay? Good. All right. Just give me a second here and we'll pull up a presentation. And we're going to try that again because it did not like to share anything here. There we go. Second time's the charm. Well, good afternoon. We're going to talk a little bit about the cattle market, the price situation in general. We'll kind of take a look at everything from really from July 1 up until now, and then we'll tie in just a couple of different marketing things, focusing a little bit on livestock risk protection because it's a newer trending a tool that's coming back into play again because of a change in the subsidy associated with that particular product. I should leave enough time at the end here for some questions as well. If there's something I can help with in the meantime, just send a chat to Heather and she will probably stop me. So thank you. Big picture, if we look at really the United States as a whole, you know, it's been a challenging production year, but what we've got nationally is a very low amount, a low percent of pasture in poor or very poor condition. That varies a little bit across the United States. In the northern plains, there's a very low percentage of pasture in those two poor or very poor categories. So here on this chart, the lower the line, the better the situation overall. So keep that in mind as well. But pasture conditions are in good shape. That should be a necessary condition to facilitate expansion or continued retaining ownership of cattle for the most part. The other thing that's of note with the cattle situation would be the hay supply. Here we have the chart of the hay situation for, so what's happened in 2019 with the hay situation. We have production a little bit higher, or supply a little bit higher than a year ago at this time. That's again varies regionally. In the northern plains, there's been very large hay, alfalfa production. In the Dakotas and Montana, Montana especially, good hay supply there. The one thing you hear about is that they were going to have a good hay crop and everything got rained on. But that aside, you do have another one of the necessary conditions to facilitate a larger supply of cattle moving forward. A couple things on the looking at the supply side of the situation. Year to date, there's been a slight increase in beef production, but it's coming from one aspect and not another. Where it is coming from is an overall increase in the absolute number of cattle slaughtered. So here it is on a daily average, month by month. So you can see that throughout 2019, slaughter in terms of number of cattle slaughtered is running ahead of last year's pace and well ahead of the 5-year average. This means that more cattle are being slaughtered, and that is offsetting or being offset by a decrease in the average dress weight of cattle being slaughtered. So that combination of more cattle is what's driving an increase in beef production for this year. It's not an increase in slaughter weights. Now, two things are going on. I'll back up to the cattle slaughtered number. That's been running higher than a year ago, pretty much across classes. The weights are a little bit different story. Weights are driven, I think, a lot of what's behind the lighter weights is the fact that there's been more heifers and cows in the slaughter mix throughout 2019 compared to recent years. So cows go through lighter slaughter weights and heifers go through and finish at lighter slaughter weights. So that's keeping the average dress weight across all cattle really in check compared to where it's been in recent years. And I'll come back to that. More heifers, the heifer situation, because that's really sending some strong, strong aggregate signals to the market. How does that play out? If we look at slight increase in beef production, that needs to be coupled with the increases in poultry and pork production as well. So we've got record levels of meat being produced in the United States here in 2019. So that's weighing on the aggregate price or overall prices in the market right now. But it's not like beef has been leaps and bounds ahead of the other meats. Beef has been holding its own in terms of production. It's those other meats that are really adding to the aggregate supply situation. Now into some specifics on cattle. Focus first on fed cattle or live cattle. Got a few things overlaid on one chart. Down at the bars going across the bottom are the futures prices, and these are the futures prices as of August 12th. Why did I choose August 12th? Well, that was the day the WASDE report was released, so I like to do a side-by-side comparison of what the fundamentals are suggesting and what's the futures price situation at that time. Since then, of course, the fed cattle and feeder prices, futures prices have been under some pressure, but this was the picture as of August 12th. So the futures prices pretty much throughout for the rest of 2019 and throughout 2020 are sitting well below most of the WASDE and the other set of price projections on there. If we look at the WASDE price projections, those are quarterly projections. So if we see for the fourth quarter of 2019, so that would be the October, November, December timeframe, the WASDE has prices pegged at around that 110 area, and then increasing as we get into the first and second quarters of 2020, in that 120, 23, 122 area. So from a fundamental standpoint, on the live cattle side right now, relative to the WASDE projections, there'd be upside potential in these markets through the middle of 2020. Now, also overlaid on here, a little more pessimistic in the short run, but giving you another picture of what may happen here in the future. We've overlaid the Livestock Market Information Center, or the LMIC price projections, and they do a rolling set of projections out for a full year and a half or a full set of calendar years. So we've got the 2019 and the full 2020 price projection there. So you can see that strong seasonal pattern that's generally reflected in the fed cattle market showing up both in the futures and in the price projections. And there too, they've got price projections for the first half of 2020 at a much better level or higher price level than the futures prices are showing at this in recent weeks. So again, both are suggesting some upside potential from where it's at. They're not too far out of line when you look at the second half of 2020. Also related to the fed cattle would be the basis level, and this would just be the cash market. Basis is cash minus futures. So if we look at the cash price for this for the fed cattle is coming out of Sioux Falls Regional Livestock Auction down in Worthing, South Dakota. It's the only fed cattle price widely reported. That's AMS reported price. And what I did is overlaid the last 5-year average. So what kind of basis level would you expect to see in South Dakota? And I overlaid that with the 2019, the year-to-date numbers. There's a little caveat in here, but for the most part, you can see that the basis levels observed in 2019 are very similar to the previous 5-year average. Now, from April forward, so rather from May forward, May, June, and July, I have a slightly different price series. The AMS has changed some of their price reporting procedures and whatnot. So the prices from May through May, June, and July here for 2019 reflected choice 2 to 3 steer instead of choice 2 to 4, which is what's been used in the past. So some of that higher, slightly higher quality is reflected in the slightly higher basis, not to the extent shown here. So I would say that regionally, and again, this is through July, regionally the basis has been fairly strong for this part of the country. And in the last few weeks, including since the shutdown of that Tyson plant down south in Kansas, the basis for August was running, got it written down here, the basis for August was running closer to $7 a hundredweight, so much stronger than you'd normally expect to see for this part of the country at this time of year. So a strong basis is a good thing, especially if a producer has hedged some cattle. A stronger basis is just a positive surprise. One of the reasons we do this or bring some information from campus, we have access to the Bloomberg financial terminals, and those terminals allow us quick and easy access to things such as this implied volatility chart. So if you were to calculate the implied volatility, you look at futures prices and options prices and see how volatile does the trade expect prices to be from now going forward. So I've highlighted just one particular contract. It's the December 2019 live cattle contract, or fed cattle contract, and I've highlighted the 50 delta area. So that just means an at-the-money option. So the implied volatility for an at-the-money option right now is about 20%. 20% is maybe a little bit higher than average for live cattle. It's not an extremely high basis or extremely high volatility. It's not extremely low volatility. What has happened, though, is in the last several months, the volatility has gone from low, very low teens up to this closer to 20%. You can see it's happening across the range of deltas or strike prices and the range of durations. So pretty much wherever you look, we've got an increase in volatility. So all of the stock market, trade news, everything else that's affecting the other markets has carried over, in addition to some of the price pressure on fed cattle that's carried over and increased the volatility, the implied volatility, and that has driven up the cost to lay off risk in the fed cattle market. So, but nice to see a snapshot of that. Very little difference across strikes and through time. It's just the overall volatility has gone up compared to what it was in the first 4 or 5 months of 2019. So back to more of a long run level, and it's pushing up the cost to lay off risk in that market. Shifting gears now away from the fed cattle, more to the other classes, so feeder cattle and calves. And I have to do something, move some photos out of the way. Sorry about that. We've got a few pictures. One, July 1, total cattle inventory, virtually unchanged from a year ago as of July 1. So very little change in terms of the overall picture. So is that good news? Is that bad news? Well, it's stopped. It's a signal that they're stopping the expansion of all cattle in the United States at this time. It surprised the trade a little bit. There were a few more cattle on feed at the middle of the year than the trade is expecting. Most of that was happening, or most of that was taking place in smaller feedlots. And then the other thing that happened is the trade overestimated the calf crop. So it should have been good news for the going forward from that time. A couple other things that come out of that cattle inventory at mid-year. We have here the chart of feeder cattle supplies outside of feedlots. So you can see that for the third year in a row, that feeder cattle supply was steady from a year earlier. I'm sorry, I'm getting some background noise here, so I've got to shift gears. Heather, are you good with the sound check? Can I get a thumbs up or something?
You're good.
All right. I'm going to keep going on then. Thank you. So two things I have to back up here. With that feeder cattle supplies outside of feedlots, that number holding steady. We don't have an increase or any kind of burdensome supply level of feeder cattle to draw from. The other thing that happened, or as of July 1, we've had a large number of cattle, beef cows slaughtered throughout the first part of 2019. Looking at the heifers held for beef cow replacements as of July 1, got a sharp decrease from a year ago. How does this play out, or what does this mean? Well, if you take that reduced heifer replacement number and add it to a stabilized or steady beef cow inventory number, beef cows have been increasing year over year since about 2014 across the United States. That number leveled off. It leveled off again on July 1. And if we add to that a decreased number of beef replacement heifers, if things sort of play out the way they normally do, I'd expect a smaller number of beef cows to start off the 2020 year with. So don't end a sentence in a proposition. What does that mean? Fewer cows having calves in 2020, tighten the supply of calves. Next fall, and decrease supply is something, hold everything else constant. We should see higher calf prices in 2020 compared to 2019. We'll get back to 2019 here in a bit. But overall, that would be a positive indication on the supply side of less calves. This says steady calves in the short run. This says less calves a year from now, and the trade will have to adjust to those tighter supplies going forward. On the feeder cattle side, you don't have quite the range of prices or the duration of prices that you've got on the fed cattle side. We've only got futures prices out through May of 2020, and we can see here you've got futures prices below both the ERS and LMIC price projections. Those have prices 140 to 145, and you can see where the futures are at. There is a little difference. The futures price today reflects feeder cattle weighing 700 to 900 pounds. So the average weight would be about 800 pounds. Both the ERS and LMIC, I'm not even sure exactly what weight class the ERS is still using, but the LMIC is using a 7 to 8 weight. So those prices should be a little bit higher, reflecting a price slide from an 8 weight to a 750 weight. You take that into account just a little bit, but it does suggest that even accounting for that, there should be some upside potential fundamentally from where futures are at today compared to where they could be. And probably a couple price levels to note. You've got that low 130 area for November, and we get out to March of next year, that too is sitting right around 130 right now. And that's probably the futures price that will be the most watched or serve as a benchmark to come up with a calf price as we get further into the fall. Volatility on the feeder cattle shows the same general pattern that we saw in the live cattle. No real pattern in terms of different expiration months or different deltas or strike prices moving in and out. You got to discount August because that's about to expire here. The rest of those contract months and everything else, we got the volatility close to 20% again in the feeders, and that's very similar to what we've seen. That's similar to the increase we saw on the fed cattle side. So the overall volatility in all the markets has carried over to the cattle markets as well. And again, driving up the cost to lay off the risk in these respective markets. I just need to check the time. I think I'm okay. A couple of price series here specific to the calves. This is a jumbled slide, and I've truncated it. I got rid of any observation with more than, I just stopped at $2.20. That hid most of 2014 and 2015, but I wanted to focus in. Got the dark black line going across the middle with little triangles on it. That's the 2019 prices for South Dakota AMS reported 500 to 600 pounds steers. Okay, a steer price reported weekly, just an average across the AMS barns that report. So it's things like places like Fort Pierre and Worthing and a few other markets in there. For the longest time, there would be seasonal price pressure starting now through fall, and that seasonal price pressure has been much less consistent over the last, really over the last decade. The last time we saw it very, very pronounced would have been 2014. You can see, or sorry, 2016. You can see what happened during 2016 there, that peach colored set of prices down on the bottom, dipping below 140. So far, prices for calves have held steady. It's a very thin time of year in terms of very low trading volume. A couple indications of where prices might be headed as we head into or further into fall. Some of the early auction satellite or video auctions had been having 5 to 6 weight calves from the Northern Plains trading a couple weeks back close to 170, and then this last week the midpoint of a few thousand head was closer to 162.50. So it gives you some idea prices at or below where they were a year ago at this time, headed into the latter part of the heavy calf sale time of year. With this recent price pressure, I think the market has responded, or the cattle side of cattle sectors have responded by those prices are so low, we're just not going to sell cattle. There were no feeder cattle sales reported this last week in South Dakota. Another way to look at things is to consider the basis. If we take a look there, so this would just be the cash price, that cash price for 5 to 6 weight average per month, and compare that to the nearby feeder cattle futures price. So it gives us an indication. Basis throughout 2019 has been below the recent 5-year average. Now, average includes some very strong basis levels in 14 and 15, but it gives you some idea of where basis is at. So that 30 or low 30 area, and that's holding through August right now as well. August is looking like 170, about a 30, $34 basis for August month to date. Another way to think about basis is if we take that futures price, and earlier today, March feeder cattle, March 2020 feeder cattle futures were sitting at $1.30 times an 800 pound steer. That would give you $1,040, taking off the price, a rough cost for hay and corn. I was coming up with about $196 of feed cost, giving a price of $844 per head, and divide that by 5.5 hundredweight, and I was coming up with $153.50 would probably be what someone would, looking at the futures market alone, would sort of bid for calves today. So that's not an encouraging price level, and certainly below where the forward contract through the video auctions, the prices have been here in recent weeks. And this flies in the face of some of the, well, to give you an idea where those volumes come from, there is big forward contract volume just July and August compared to other months that you can see. If you'd like more information on this, we can get that to you from the Livestock Market Information Center. Last couple things related to fundamentals, a couple of things in my notes. We've got very low supply of beef in cold storage right now. That should be a positive piece of fundamental information. So if you're looking for, is there some good news out there? Tight supply of low stocks of beef in cold storage. So even with the slaughter facility problems, there's not a backup of ready beef in the market right now. The packer retail margins have been tough to discern or make sense of. The margins are better than they've been At the same time, it depends on what you look at. If you look at the cutout values or if you look at some of the wholesale prices. Last thing I'd like to just highlight for a moment would be the changes in, small changes really, but changes in livestock risk protection. Livestock risk protection, or LRP, is available through crop insurance agents, and it is just price protection, so it won't help you if cattle don't gain well or something were to physically happen to the livestock. It's just price protection. But starting on July 1 of 2019, through the risk management agency, they increased the federal subsidy rate on the premiums for livestock risk protection. That should mean the cost of this coverage goes down. Now, you don't want to rush out there and buy coverage at with lower price levels, but if you're more proactive about it, or we get a rally or something like this, LRP could again be a useful tool, especially if you're looking at perhaps backgrounding this year's calves, take advantage of available forage and pasture, whatnot. Taking advantage of that, holding on to the calves maybe longer than you normally would. That would be a time to take a look at something like livestock risk protection or put option protection on something that will end up being a feeder weight by the time it's sold. I wanted to highlight LRP in part because South Dakota, after a very low volume covered during calendar year 2018, there has been an uptick again. And in South Dakota, relative to other states, there's fairly strong use historically and this year as well in terms of number and number of head being covered by LRP. So in South Dakota, year to date, there's 27,714 head covered by LRP. Now that's relative to about 2 million head of calves and feeders and backgrounded stuff that could be eligible to use the coverage on. So it's popular. It can be looked at. It works really well on calves, can be considered for feeders as well, especially as we go into that backgrounding phase. So wanted to highlight that. And one other thing to highlight, if you are interested in more information, you can find some of the historic prices and other information on the extension website. That's extension.sdstate.edu. Link was added recently to give a more direct link to the In the Cattle Market series on one of the several authors. We all take turns once a week contributing to the In the Cattle Market series through the Livestock Marketing Information Center. That's available through a link on the extension SD State EDU website. So if you're looking for some information, some of the price information should be available. Historic price information should be available on the extension website going forward as well. So with that, if you have questions, I think I'm kind of used up most of my time, but if Heather will allow it, I would take a couple of questions. So that's all I was going to cover. So I turn it over to Heather.
Okay, so I think I'm unmuted at this point. Anybody have any questions related to livestock marketing information or LRP that Matt just shared with us? I don't believe I have any in the chat box right now, so if you tried to type something, there's nothing there yet, so please try again. Okay. Don't see any notifications that anybody's typing anything. Matt has put all of his contact information there on that screen for you. So if you would like to send him a direct message or call him, I'm sure he's open to that. Make his phone ring off the hook and he will answer your questions for you based on any of the slides that he presented today. With that, I think I will invite Tom to share her slides. If she wanted to go ahead and share those, I will mute everything from the Sioux Falls side and we'll move into our next presentation.
Okay, can you see my slides now? I think I already shared, but not quite sure.
Tom, we can see him, yes.
Okay, that's good. So can you see the full screen size? I think full screen, but it looks like it's, it's full screen on the other screen. So this one, how to manage this? I think I share wrong screen. This one is just not full screen. Let me share again, okay? I think I share a wrong screen. Share. Okay, so this time should be fine. Okay, good afternoon, everyone. So my topic this afternoon will be the cover crop usage in South Dakota, impact on economic profitability. So first of all, I want to give you a brief overview of the census data. So we got the USDA census data pretty recently. So I compared the 2017 census data with the 2012 census data on the share of cover crop usage by county in South Dakota. So here, as you can see that in 2012, so most of the counties on the East River side has less than 1% of cover crop usage areas. But then in 2017, 5 years later, we can see that most of the counties already have between 1 and 3%. So if you see this map, so this one gives a changing share of cover crop usage between 2012 and 2017. So we can see most of the East River counties, it has over 100% increase in cover crop usage. So those dark green points, you can see that there is actually a 120 to 150% increase in cover crop usage. So it shows that the cover crop usage in South Dakota has been increasing very rapidly in recent years. So in 2018, we did a South Dakota farmer survey pretty much in the East River. So this shows our survey area, and we asked people about their cover crop usage opinions and their different usage status. So we got about 710 survey responding to our survey. So those are the summary of what we got. So you can see from this summary that basically we can see about half of the producer we surveyed, they mentioned that they have never used a cover crop by 2018. And we found there about a quarter of producers, actually they have just been using it for less than 3 years. So this shows that in less than 3 years, lots of cover crop users have been adopting this practice. And not many people actually use it for a longer period. So, and you can see that even 11% actually used for 3 to 5 years, and 14% have used it for 6 years or more. And there are only 2% they show actually answer that they used a cover crop before, but they have discontinued recently. So not too many people have discontinued. So that's the percentage of producers in different usage categories. And then based on their usage categories, we ask some questions. And so this is what we ask about what they perceive about their cash crop yield change. So basically, you can see there are different bars. So this blue bars means never used. And so this orange is less than 3 years. And so the yellow one is more than 6 years. And the dark blue is discontinued. So this line actually means it's number 3. So we give different numbers, 1, 2, 3, 4, 5. The lower you go is the yield have decreased. And the 3 means a little change, and the 4 means actually between 5% to 15%, and 5 means about 15% increase in the cash crop yield. So we can see that about people's perception of those people who have never used, actually on average, they perceive the cover crop yield will be decreasing somehow. And for the people who have used the cover crops, we can see there is an increase when the years of usage have increased. For example, when the people have used it for less than 3 years, compared to 3 to 5 years, compared to 6 years and more, we can see there is an increasing pattern, especially with people who have used in 6 years and more. And people who have discontinued, I think they somehow they believe it have decreased crop yields. That's maybe the reason they discontinued. So this one actually is from another survey. So because our survey we only did in 2018, so we got people's perception of that year. But I took some data from the SEER survey. They actually did it from 2012 to 2016. So they have 5-year data. So I compared the 5-year data for the corn and the soybeans. Those are actually producers' response as well. So you can see that the corn and soybean, if you compare those numbers, so the cash crop increase for the soybeans is always higher than for the corn. And another trend you can see is the 2012. So 2012, as we all know, is a drought year, but we can see that if you use cover crop compared to the field that cover crop was not used, so the yield has been significantly increased for 2012. But for those years with a normal rainfall, the cover crop advantage is not that evident. So from this trend, we can say that the yield increase and should be most evident when there's either drought. We don't know, maybe there's an extremely wet year, how it performs, but from this trend, at least we know that in the drought, cover crop actually gives more benefit. And again, we ask about the production cost. So here we see the opposite trend. If you use it for more years and people reported a lower production cost. So I think the reason is because when you use it for short years, you have the seeding cost, and maybe there's no reduction in the fertilizer, herbicide cost. So there is only an increase in the seeding cost. But when you use it for more years, then there is more improvement in the soil health, so you can reduce your fertilizer and the herbicide cost. So we can say that those have never used reported they perceive there is a highest increase in production costs. That's just their perception. And for those who have discontinued, they actually reported a very high cost too. But for those who have used it for 6 years and more, they reported the lowest production cost increase. Finally, combined, we ask about the perceived profit change. So the profit change actually corresponds to the increase in the cash crop yield and the decrease in the cover crop cost. So combine those two factors together, we can see that those who use it 6 years and more, they have perceived highest profit increase. So this line again shows there's no profit change. So we can say for those who even use less than 3 years and 3 to 5 years, they have perceived a profit change increase. And those who use 6 years or more, they have perceived a much higher profit change. And then we ask about the perceived cover crop benefits in South Dakota. So this shows what's the non-adopter opinion and what's the adopters of the more than 5 years opinion. So the red bar here, you can see the non-adopter opinion, and the green bar is the adopters of more than 5 years. So we look at all the benefits here. So for every category here, basically the adopter perceives higher benefits than the non-adopters. And among the adopter perceived benefits, we can see that one of the highest benefits is suppresses weeds, and the other is helps livestock grazing on the cropland. So those are several factors that the producer mentioned, and it could have economic impact on the usage of cover crops. For example, this livestock grazing item, we basically checked people. Okay, so this is a agreement line, so we can see that most people have showed agreement for adopters. People show agreement to each of those items. So for the livestock grazing item, we actually checked what's people's different opinions for people who use cover crop for grazing purpose, and people don't use cover crop for grazing purpose. So we checked it based on whether people have pasture or not. So for those who have pasture, we assume that they use a cover crop for grazing purpose too. So we ask them about their perceived profit change. And for those who have no pastures, we ask them the same question. So this is, again, the no profit change line. And we can say that there is a, for those people who have used a cover crop for grazing purpose, they perceive there is an increase in profit, but for those who are not using it for grazing purpose, there's no perceived profit for this category. So for summarize our survey findings, we think that cover crop is actually should be viewed as a long-term investment instead of a short-term investment that pays off in a year or two. So for example, you know, there are other farming investments where we don't expect it to pay off in the first year. For example, if you purchase a new farm machinery, you don't expect it to pay off in the first year. Or if you purchase a crop insurance, it may not be immediately a bad year that you expect to pay off. So we can think about cover crop as more as a long-term investment in this regard too. And cover crop does pay off faster under certain situations. Here I listed several situations here. One is cover crop plus grazing, as we showed before. If people have grazing land, they do view there is a benefit economically. And another one is incentive payment from the federal or state programs like EQIP. It helps farmer pay off cover crop investment faster. And another situation is a severe waste problem in the field. So actually it saves a herbicide cost. So it will be another situation that cover crop pays faster. So today I'm just going to focus on the cover crop and the grazing and show off how, just showing how that cover crop plus grazing are going to increase the economic profitability. So the approach I use is a partial budget approach. So we have the cover crops and we have grazing. So there will be some added income or reduced income, and there will be a reduced cost or added cost. So I'm going to focus on the added cost here. So we can see there are several categories of added cost, like cover crop seed cost, planting cost, termination cost. And of course, if you have grazing taking place, there will be fencing cost, water tank cost, and the water hauling cost. So I'm going to emphasize on those added costs, and there will be a reduced cost. You know, if you have grazing, then there will be a reduced forage cost. And as you use cover crop for longer years, there will be a cash crop yield difference, and there will be reduced fertilizer and herbicide cost. So first of all, I'm going to the added cost due to this cover crop adoption. So first of all, there are added seeding cost. So the seed cost would be, we choose different categories of seed. So this one is, we assume there is a low residue legume blend. So there is a mix one. So you could use cover crop for different purposes. It depends on the needs. So we have actually tried 3 mixes here. This is the first mix. So the low residue legume blend, we have a higher quantity for P here. So it's 10.5 pounds, and we got the price for each of those cover crop seed. So per pound, and we got the pounds per acre. So basically we can calculate their price, dollar per acre, and sum it up. So this one would sum up to about $22, and there will be a mixture fee about 0.7 cents per pound. Add on the mixture fee would be $24. So there are 6 different seeds here, and we are going to change a little bit about the proportion of each seed. So for example, this one is a high residue grass blend. So for this one, instead of a higher pea quantity, we have a higher oats quantity. So it's 42 pounds for oats. The price per pound is the same, but we have a different proportion here. So add up a little bit different, about $21.32. So we have a higher mixture fee here because of the larger quantity of oats. So again, it get up together to $25. And besides those legume blend and grass blend, we have an equal blend. But the total price is similar. So for those 3 different blends, we have different purposes, but the price calculates kind of similar, about $25. So we actually averaged the cover crop seed cost for the 3 seed blend is about $24.84. And then for the cover crop planting cost, we assume that is based on the customer rate for the grain drill. It's about $15 to $20 per acre. So we took the average, which is about $17.5 per acre. And then there could be a cover crop termination cost. So if you use a herbicide cost, we assume is 32 ounce Roundup, the Weather Max, it's about $4.7 per acre. And with the application cost of $7 per acre, that sums up to $11.7 per acre. And the termination cost could be 0 if you have a spring burn down herbicide application anyway, so it won't cost extra for you. But we add this cost just to make sure we take care of everything. Okay, so that's the cover crop seed, planting, and termination. Another category of added cost, it would be the livestock side. So for livestock side, we need the fencing cost. Here we have the wire, a pigtail post, and the solar-powered fence energizer. So I will calculate how much each of this cost. So for the fence and post, it costs about $14 per acre. So because it's actually varies, depends on the shape of the field. But generally it ranges from $12 to $16 per acre. So I took the average, it's about $14 per acre. And for the fence energizer, it's cost about $300, but it is capable of charging 50 acres. So I took the per acre cost is about $6 per acre. And for the livestock, we need the water source. So there could be different ways to supply water, but I just calculate what is the cost of the water tank here. So we think about we can purchase a water tank with the 600-gallon capacity. So assume that 2 gallon per 100 pounds of body weight, then 600-gallon tank could actually supply cattle that weighs 30,000 pounds. That's about 40 head of cattle that weighs 750 pounds each. So we assume that one cattle grazes on 1 acre, that's about 40 acre of cover cropping land. So we can calculate what's the water tank cost per acre. So basically divide the total cost by the total acres we use. And for the water hauling cost, so we assume that water is hauled every day. And because we already get that 600-gallon tank actually supports 40 acres or 40 cattle. So we assume that the cattle actually graze for 90 days. So this is kind of realistic in South Dakota, and is kind of taken from data in the experimental station. So with the 90 days grazing time and with the water hauling cost, take care of the mileage cost. We assume it's a 0.5 mile each trip, and we take care of the labor cost. We assume the hauling takes about 15 minutes of labor time. So add up those together, we can calculate a per acre water hauling cost is about $7 per 0.35 per acre. So that's the added water hauling cost. And finally, we come to the reduced cost. The reduced cost comes mainly from the reduced forage value from the beginning, because we don't see the soil improvement maybe it's from the start, but at least we can have some saved forage cost. So assume that our stocking rate is 0.75 animal unit per acre for 90 days, and the forage consumption is 26 pounds of dry forage per animal unit per day. We could actually save about 1,750 pounds of dry matter per acre. So that's about, like 3,500 pounds of dry matter at a 50% utilization rate. So with 1,750 pounds of dry matter, we use the recent East River, South Dakota alfalfa large square cost. At a fair condition, a large rounds cost 130 per ton. So we can calculate what's the saved forage value per acre for that 90 days. So together for 90 days, the saved forage cost would be $114 per acre. So after calculation of those added cost and the saved forage cost, we can put up together. So we have the cover crop seed cost, the planting cost, the termination cost, and the livestock fencing cost, water tank cost, water hauling cost. All put together, we have the added cost portion as a negative effect. Add up together would be $87.77 in our case, but our positive effect with cover crop grazing would be $114. So overall, we still have a net positive effect. So the net effect for the first year would be about $26. And then come up to our second year. So second year, I assume the same cost for the cover crops, the same cost for the reduced forage, but the fencing cost and the water tank cost, we don't need for the second year because we already have them there. So both of them last at least 10 years. I heard people mention that they have it used for 20 years or more. So we assume the second year, those two costs comes to zero. So add up the other cost and we can calculate what is the net effect. So the net effect here is about $52. It's much more than first year because we saved the investment cost in the second year. And if we come to the third year, so for the third year, I assume that because I took the SEER technical bulletin, they assume that in the third year, you can basically increase the corn yield by a certain percentage. Here, I assume that there is a 2% increase in corn yield. So of course, there could be more percent yield if it's a drought year, but I assume just a 2% increase. So for the 2% increase at a $3.5 per bushel corn price, we can calculate the actual benefit from the yield increase is $14. And there could be a reduced fertilizer cost. So we assume that we can reduce the nitrogen by 15 pounds per acre and reduce the phosphorus by 25 pounds per acre. So we have the unit price of nitrogen and the unit price of phosphorus. Together, we can calculate what's the reduced fertilizer cost. Here is about $14. And then reduce the herbicide cost. So we assume that we reduce the herbicide passes or we use a less expensive herbicide product. So about $10 decrease in the herbicide cost. So from 3 year and above, if you go to the 5 year, these items could be increased even more. So I calculated the total positive effect would be $152 for the 3rd year, and the total negative effect would be only $61. So the 3rd year, we have a higher net effect that it would be $90. So we can see there is a trend of increasing over the years if we use cover crop for the grazing purpose. So for the concluding remarks, for the partial budget analysis I use, it indicates that if we utilize the cover crop for grazing practice, it will increase the 1st year economic profit by $26, increase the 2nd year economic profit by $52. And if we think about the longer term, it could be increase even more because there is an increased cash crop yield, and there is a reduced needs for fertilizer and herbicide. So that concludes my message for today. And thank you very much for your attention. Just let me know if you have any questions. Thanks.
So any questions for Tom? If you have them, you can sure type them into the chat area here quick, or raise your hand and I will try to mute here and you can ask them live from your location. Okay, so I'm not seeing any questions come in. I don't see any hands raised in any of the other spots. So Tong had her contact information up there. If you had questions for her, please give her a call there or send her an email. I can also get you in touch with her if you need that information as well. Since we're moving right along on time, you guys are doing a great job, presenters, on keeping this on schedule. We're going to move into the 3rd and final presentation for today. And we'll turn it over to Dr. Matt and Dr. Lisa Ellie.
Great, thank you, Heather. We're going to cover kind of the look of what's happening this year with preventive planting. Big preventive planting year in South Dakota has pretty widespread impacts that we'll kind of show in this slideshow, and then also just talk a little bit about the trade program payments, the MFP payments, and what those impacts will do for South Dakota grain value at more of a state level, just to kind of give you an idea. So our slides are some of them are fairly detailed with maps and things like that. So I included on here a link where you can actually download the slide presentation and look at it yourself in more detail, more closely. So that link right there will lead you to that. So just kind of a recap. As most of you already know, we started out this spring planting season. It was very cool and wet during May and April, when we generally are trying to get into the field and do some of our normal planting and field work. And so you can immediately see how this year started out very different from past years. The dark green lines in these two charts show the planting progress over the different years. On corn on the left side, and then soybeans on the right graph here. And then, just to kind of put into perspective, at June 2nd of this year, normally we would have about 96% of the corn planted in South Dakota, but at this year, during this year, we only had about 44% of intended planted acres planted at that point in time. So, a lot of that probably ended up preventive planting. Some of it was planted really late corn. And so we'll talk about that a little bit more. And then the same story with soybeans. So if you're looking at June 9th, we had about, 43% planted, and typically we're about 93% planted on soybeans in the last 5 years at those points in time. So first, I'm just going to talk about preventive planting for all the major crops. And first in the United States. So as of this morning, the office or FSA and the chief economist at USDA updated their latest reported FSA numbers for preventive planting throughout the United States. So we're up to 19.8 million prevented planted acres throughout the United States in 19, and this is by far a historical record. Down here in this lower left graph, you kind of can see the prevented planting acres in the past years, and we're not nearly twice as much as our previous high in 2011, but we're getting close to being twice as much than we saw then. And this preventive planting really hit South Dakota particularly hard compared to the rest of the United States. So in this map, it's showing in the dark green areas where we're seeing the most prevented planting acres. And so you can see most of South Dakota, especially on the eastern part, is seeing a great deal more prevented planting acres in a lot of the counties, but also some notable areas, definitely in that northern section of Illinois and the northwest section of Ohio. We saw some large prevented planting acres, and then in Nebraska, where we had some of those issues with the dam breakage and things like that. But overall, we're looking basically at 20% of the U.S. prevented planting acres are actually in South Dakota. And this gives you kind of a more detailed county by county look and the number of acres in each of these counties in South Dakota. So 3.9 million prevented planting acres of all your major crops in South Dakota. And you can see the different areas or different levels in different counties here in this map here. So if we look at how did major crop plantings change year over year from 2018, and again, all our major crop plantings in South Dakota have dropped. So we're showing decreases in the number of crops that are just planted in South Dakota from 2018. In fact, 30% of the lost acreage in the U.S. was basically in South Dakota. So that's somewhat of an issue that affects that grain crop value as we're looking forward to harvest in the next marketing year. Again, here's a more detailed map of those major grain crop changes from year over year. So 3.5 million acres less in South Dakota. You can see some of these counties that have a lot less major crops planted than they typically do, or at least compared to last year. Definitely East River was hit the most, and primarily in the southeast portion was hit really hard. So now we'll just kind of focus on corn acres and looking at the prevent planting. So most of the prevent planting was in corn acres. 2.8 million corn acres in South Dakota were declared as prevented planting according to the FSA. And that's about 70% of the prevented planted acres that were reported in South Dakota were actually reported as corn prevented planting acres. So if we start thinking about what does this mean for the amount of corn crop that's planted in South Dakota this year compared to last year, well, right now, the USDA NASS in their August 12th crop report thinks there's about 4.5 million acres of corn planted in South Dakota. And last year, we were looking at roughly 5 or over 5 million. And according to FSA, reported corn acres last year was 5 million at this time. And for this year, FSA reported corn acres was 4.1 million. So definitely probably a million acres off of corn in the state from last year, year over year. And so you can see where the impacts are greatest, definitely in the southeast area, is where we're seeing the most. But we actually see some increases in corn acres, for example, in Brown County and some of these other northern areas. So that's something to keep in mind as well. So if we look at the nationally, what's happening with corn acres. So even though South Dakota is down in corn acres by about 1 million acres this year from last, overall from last year for the United States, we're about the same. We've had the same amount of planted acres as we did in 2018 as we seem to in 2019. And what's happened? Well, we lost acres, corn acres in those very impacted regions of where we're seeing a lot of preventive planting, like in South Dakota and Illinois and in Ohio. but we're seeing increases in acres in other states like Kansas and Nebraska and parts of North Dakota and northern Iowa. And so those acres, those additional acres are offsetting the losses that we had in some of these states where we've had some real preventive planning issues. And so that's what caused a really bearish world supply and demand report in August that's kind of really suppressed prices since then. So if we shift our attention to soybean acres, and we can see we have about 851,000 acres of soybean preventive planting acres in South Dakota in 2019. Again, you know, East River is where we generally plant most soybeans, so naturally we see a large portion of the preventive planting in those counties. And then if we're thinking about what is the change in soybean acres in South Dakota relative to 2018 to this year, well, it's way down, and in some of these counties it's down pretty significantly, and that's there's a couple reasons. Number one, preventive planting, but also the price prospects and profitability prospects between corn and soybeans favored corn a lot more this year, and so we see a lot of people shifting away from soybeans and into corn, and so that's where there's two reasons for why soybean acres will be way down in South Dakota. So, for example, in August of 18, the reported acreage of soybeans to FSA at the time was 5.4 million. And this year we're looking at 3.3 million. So quite a bit of a decrease. And then in the USDA NASS report for South Dakota, they expect about 3.5 million of planted acres of soybeans in South Dakota. And nationally, like I said, again, corn was the favored choice over soybeans this year because of the economics and price incentives, partly related to the trade war and some other issues. And so we've just seen soybean acres decrease throughout the United States, but you can see most of these decreases are coming from North Dakota and South Dakota, but there's decreases throughout the major grain belt. Specifically, last year we had about 89.2 million acres planted to soybeans throughout the United States, and this year NASS in their August report is expecting about 76.7 million acres. So almost, you know, a 12 million acre drop from last year. So if we turn our attention to thinking about what's preventive planting and going to do with the production, the amount of yield that we have. And a little bit that's unknown at this point in time, because not only do we have less acres, but we also have a generally later crop. And you can kind of see that in these progress numbers. On the left side here, we have the progress of corn silking. And this dark green line is this year, and the light green line is the 5-year average. So at the end of July, only 27% of the South Dakota corn crop was silking, and we're typically at 77%. So usually, you know, we're a lot further along with the crop, and so the late planting is impacting the development, and that can raise some real concerns for the amount of yield loss that can occur if we have an early frost, or just in general, because in general, when you plant later, you just don't get that grain fill and the ideal weather to really make a nice or high yielding crop. So those are some concerns. We have the same story when we're looking at the amount of soybeans that are setting pods. Typically, by August 18th, we have 87% of the soybeans in the state setting pods, but this year we only have roughly about 60%. So, you know, again, these crops are behind, and it's going to take a little bit of a longer season in order to get them finished, and hopefully they can, you know, reach somewhat of their full potential. Another look at another thing we look and monitor, thinking about yield, is the satellite data. So we're reading or monitoring a lot of the satellite data imagery throughout the growing season, and this is when the satellite imagery starts to becoming more correlated with yields, and we can see that this crop is not only planted late, and so it's not nearly as green, as they say. So this is the Ndvi difference, or normalized vegetation difference index. And this is looking at Brookings County and Hutchinson County in this particular case. And these counties both were hit hard by preventive planting. And so the red line's 2019, the blue line's 2017, and then the green line is 2018. And so as the crops mature and develop, they become more green and there's greater biomass, and that's what this Ndvi is indicating. But you can see that we're coming up shallow. It was a little bit behind throughout the whole year on the green up phase, and that's just because of the late planting. And then we're coming up a little shallow in these counties of it not really hitting that peak greenness and peak biomass levels that we would expect in order to get high yields that we've had experienced in the past in some of these counties. So that's what's being indicated when we look at these Ndvi differences, and kind of gives us a signal that, you know, the yields are going to be down from the previous years anyways. And if we think about this from the whole area of South Dakota, and especially East River, where we have a majority of our crop production, in the green areas, we're having actually Ndvi where it's above 2018s, and then in these red, brown areas, we're seeing decreases. So it's not all of East River seeing lower Ndvis. In fact, the north central areas and some of the central area is seeing positive Ndvis. And then if you look at Ndvi through the whole East River, we're actually, even though we're a little bit late to get to our peak green phase from 2018, we're about at that peak greenness or Ndvi level that we had in those previous years. And 2017 is a little bit different because we had a widespread drought in certain portions of the East River area. And so our greenness was really slow and slow developing, and yields suffered as a consequence. So it's not nearly as impactful, you know, looking at Ndvi here as the 2017 yields, but, you know, not nearly as good as the 2018 yields. And so that's something to keep in mind. So we have the initial USDA NASS numbers of, you know, they do a survey of growers of each state, what they expect yields to be. And we just got those numbers on August 12th. And so NASS in their report on August 12th, they expect South Dakota corn yield of 157 bushels per acre, and that compares to about 160 bushels from last year. So as the crop develops and they resurvey in September and October, we'll see how this number changes. But I would expect that this is probably a little bit high and optimistic, and that we'll see that number come down. More recently, the Pro Farmer does an actual crop tour of the southeast portion of the state, probably in one of the worst areas of South Dakota. But they did a crop tour where they're picking ears out of the field. And in South Dakota, they estimated 154 bushels an acre on the samples they pulled. And last year for the same tour, they had about 178 bushels per acre. So they're showing about a 13.5% decrease from last year on yield in that southeast portion of South Dakota. And so, you know, they're picking up a little bit more of that yield loss than maybe NASS is. But again, they did not survey all the portions of South Dakota. As I mentioned, north central and central areas might be a little bit better if they can actually finish the crop. And if we look at soybeans, it's even worse. You know, NASS right now is at 45 bushels an acre on soybeans, and that's just 1 bushel per acre down from last year at 46. But if you look at the pod counts in these 3x3 plots in the Pro Farmer Tour, they were down 19% from the previous year. So that's definitely a concern that, you know, there's just not as many pods because the soybeans were planted so late and so forth, and that can really have an impact on yield. So one of the big unknowns about thinking about, you know, what is the amount of grain that we're actually going to harvest for corn in South Dakota this year, and not only in South Dakota, but also in the U.S., is what is the harvested percent going to be? And generally we hover around, 91, 90% harvested percentage in the US. And in South Dakota, we might be a little bit higher than that, maybe about 93 or 4%, at least in East River, South Dakota, and that's been trending upward. But if you take a look at some of these years where we've had some preventive planting or flooding issues and delayed crops, like 1993, for example, that harvested percent drops down quite a bit from the average values. For example, 1993 in the United States, it was already all the way down to 86%. And you can see in South Dakota, we've had some points where it's gone down around 85% and so forth. So, there's a real concern about how much of this grain crop or this corn crop that's planted, how much is it actually going to get harvested for grain? How much is it going to be used for silage and other forage uses and so forth? And so that can really impact what our overall production amounts are. And so here I kind of have a table just kind of exploring different analysis using the USDA NASS number of 157 bushels per acre and the 4.5 million acres. I'm looking at the amount of bushels of corn that we can expect to be produced in South Dakota this year. And so if there's no change from yield from NASS, this means 0. So we're in this column. And then we're just looking at harvested percent at these different levels in this column. So we're looking anywhere, if it's an 80% harvested percent level, 565 million bushels an acre, or a million bushels of corn produced in South Dakota with this type of yield and this type of planted acreage. And if we had a high level of harvested grain, 671 million. But if we're looking at a larger decrease from this level, so closer to that pro farmer level, and we're looking at somewhere between 90% and 85% harvested, we're looking at 540 million bushels of corn produced in South Dakota, or 572 million bushels of corn produced in South Dakota. And that compares to last year where we produced 777 million bushels of corn in South Dakota. So definitely a decrease in corn production is expected at this point, given all the information out there. I would expect there even to be a little bit more of a decrease. I would be thinking somewhere in between these four squares is probably where we're going to end up on corn production for grain in South Dakota. Now, soybeans in general, you don't really have that as much variation in harvested percent. So we don't have all these options of harvested percent, but just looking at that NASS yield number of 45 bushels an acre, and then 3.5 million acres planted. And then we're looking at, if we had a 10% drop from that NASS number, we would be looking at 134 million. If we have no drop and the NASS number in August is right, we're looking at 149 million. But either way, all these numbers are much lower than what we had in 2018 of 256 million bushels of soybeans produced in South Dakota. And that's because of preventive planting, but that's also because of acreage shifts away from soybeans to other crops or whatnot. So if we take all these numbers and we start thinking about what does this mean for the grain value in South Dakota this year, generally, prices were relatively high up till this last August report, and then they've kind of fallen off quite a bit. But if you look at the state prices received data, so this is the actual prices received that producers or that grain buyers are reporting to USDA NASS that producers have received in 2019 in South Dakota. On average, for corn, we're looking at 343, so a little bit higher as of June compared to the previous years on corn. But in soybean prices, we're seeing a much lower price. And partly related to the trade war with China and so forth. So, 790 is much lower than what we've seen in the past on soybeans so far. And then if we're looking at the wheat price, it's about an average in between where we've seen prices before on wheat. And so if we think about just taking those production numbers I was talking about before, multiplying by those average prices received, and then and looking at what the change is across these commodities, You know, already even with the NAS yield levels where they're at, and given the preventive planning and the planted numbers, we're looking at a $1.2 billion lower value in grain crops in South Dakota this year compared to last year. You know, usually between the three major crops, we have roughly about 5 billion, and we're looking at right now 3.7. And again, I think this number could be a little bit lower. So then what, you know, the offsetting effect here is that we do have this market facilitation program. This is supposed to be the payments that are paid to producers to kind of offset some of those price effects from that trade war to supplement farmer income, and then also, you know, revenue in the state that's lost because of the trade war. And so they announced the MFP2 program, which, you know, payments will start here in August. And there'll be 3 payments as long as there's the trade war continues. But by county, per eligible acre, we show the amount of payments that an individual can get. So obviously the highest dollar per acre payments are in these very southeast counties, you know, $69 down here. And then as you move up into this northern area, down into the $50, $40 an acre. And then out in West River, mostly around $15 an acre, but here in the central, south central part, around $20 an acre. So in the MFP2 program, they did allow payments for preventive planting acres if you planted a cover crop by August 1st. But you were only allowed that minimum $15 per acre payment for the cover crop, not this full payment that they're giving you for an actual planted crop you intend to harvest. And so all preventive planting acres, you know, are going to get a lower, that lower $15 amount than they are actually going to get this full payment rate. Also, that if you're 2019 acres that are planted or preventing are higher than your 2018, then you're going to use your 2018 acres. You can't exceed your 2018 planted acres for eligible acres. Now, how does the MFP2 program, this market facilitation program, compared to last year's market facilitation program? Well, it's quite a bit different in the sense that now there's just an average rate per acre for all eligible crops in a county that are paid. But when USDA released their methodology of how they came up with those dollar per acre payment rates by commodity here, and we can compare those to the MFP1 commodity payments. And so last year for corn, for example, you know, a lot of people felt that corn didn't get as much as they should given the amount of trade damage that was done to the corn price. They were only paid 1 cent a bushel last year. That's increased to 14 cents a bushel this year. Soybeans are increased. They were $1.65 per bushel payment last year, and in this program MFP2, they were paid up to $2.04 a bushel. Wheat got increased from 14 cents to 41 cents. Sorghum increased, cotton increased quite a bit. And then there's crops that we didn't pay last year that are actually getting payments this year. So you're going to see a lot of payments down south for rice, peanuts, and then also for alfalfa hay are getting paid in MFP2. So if we look at the eligible payments in dollars for these different counties, this is for MFP1. In these counties, you can see most of the eligible MFP1 payments, these are the last year payments that could have been paid, were in East River, basically where there was a large amount of soybean production. Those got significant more payments, and West River didn't get much. But if we switch now to MFP2, you're going to see a lot more payments out in the West River area, and again, because of alfalfa is getting paid. But also wheat acres are getting paid more and corn acres are getting paid more. And then most of the counties increased in value. I noticed there's a few counties in South Dakota that we actually expect maybe a decrease in the amount of payment. that will go to that county, and that's largely because those counties have a really high level of PP where they're only getting $15 per acre, and there typically were a lot of soybeans planted where they were getting $1.65 per bushel on their soybean production in 2018 for the MFP1. So there's a couple of these counties actually that probably are worse off than they were last year in the amount of MFP that they could expect compared to the MFP1. So if we just kind of put these numbers for South Dakota, so MFP2, just eligible amount, what we estimate somewhere about $546 million in eligible payment could be given to South Dakota. And that's an increase from our eligible on MFP1 of about $390 million. So roughly about $150 million more dollars in trade payments will come to South Dakota relative to that MFP1. Now, we kind of just looking at, well, what if the prevented planted acres were actually paid the full rate of payment instead of that $15 per acre? Well, you'd actually have the potential seeing $683 million or $684 million of eligible MFP2 payments in South Dakota. So we're losing quite a bit of the MFP payment because we have so many prevented planted acres this year in 2019. So it's just something to keep in mind. So if we add all these together and we're looking at, what is the overall impact? So we look at those three major crops and total South Dakota grain crop value over these years. And then here in 2018, we have the MFP1 that adds money. And then in 2019, we have the MFP2 of 546. And still, even with the current yields, we're looking at, crop or the total grain crop value being lower than 2018 by about $1.2 billion already. And it's probably going to be less than what we're looking at here. And if you look back all the way to 2015 over these three crops, even with the MFP included in it, we're still looking at much lower amount of grain crop value in the state. And because of preventive planning, because of the trade wars, and the MFP isn't really offsetting all the effect and so forth. And so it's just one of those things that we're kind of monitoring. We'll see how it goes. I will note that none of these values include insurance indemnities. So from prevent planning, we're going to get some of that lost revenue back through the insurance indemnities, but I didn't include insurance indemnities on any of the other years too. So this is just looking at South Dakota crop grain value without any insurance or anything like that, and looking at what likely impact, but it's definitely looking like less than we have seen in previous years. And so with that, that's what I have. I'll take some questions. I think I'm right on time.
Okay, does anyone have any questions?
Sure. Okay,
we'll try again.
Any questions for Matt?
Or questions for Dr. Tong or Dr. Dearson? Is anyone? Okay, so I saw some microphones have gone unmuted. So I'm going to make a guess that Nikki, do you have a question? Or Don? Okay, I'm not sure if you are talking, we're not having a connection back and forth. Also see that, well,
Yeah, Nikki said no, so.
oh, okay, there we go. Okay, well, the contact information was presented by each of our presenters at the end of their presentations. So if you do have questions for them, please shoot them an email or give them a call. If you can't find them, please always feel free to give me, Heather Gessner, a message or a phone call here in the Sioux Falls Regional Office, and I will try to get you hooked up with the right person to get your questions answered. As we go forward, there is another economics dialogue scheduled for September 16th at 2:30. You can register for that through the SDSU extension webpage as well under the events tab. So please look there for that. And seeing no further questions, I do want to just kind of tongue-in-cheek remind everybody that this is labeled a dialogue, so we really do encourage conversation and questions as they come forward, not designed just to be something that we talk at you. So next week or next month, excuse me, we sure look forward to maybe increasing the dialogue back and forth with you, our constituents out there in the field. So with that, no questions have came in the chat area, so I'm going to say thank you, and we'll sign off from Sioux Falls and talk to you in a month. Thank you.